So on the whole, yes, you're right. The Q1 number at 7.4 is better than the consensus. And in terms of the quality or the high frequency March numbers, it's still showing some slowing of momentum, especially in the investment numbers, and a slightly smaller than expected rebound in industrial production. But overall, I think given where the market was and the expectations around Q1, this has to be, a positive surprise. So our full year 2014 forecast actually hasn't changed this year. We've been at 7.4 for the whole of the year, and so we don't think today's number has a material impact on that, so we're still fairly comfortable with 7.4 for the year. I don't think so. I think, first of all, it's still very fragile in terms of for example, the March activity data. You're still seeing some slowing in momentum, and of course, you've had also quite a bit weaker data in both exports and also the M2 growth numbers. So we still think some help is needed just to stabilize the growth profile. But in terms of monetary policy, yes, I think it probably means that you won't get as aggressive a reaction as, say, a cut in the triple R rate or in the policy interest rate. I think on the whole, if you look at some of the trade data, and this has probably surprised down more than up this year, but if you smooth through, first of all, the seasonal distortions from Chinese New Year, and also some of the base effects from the over-invoicing trades from last year, you'll find actually the underlying trend has still been positive for Q1. So on the whole, yes, domestic demand is slower, and that's probably going to affect some countries that export to China, especially perhaps if you are, say, exporting a lot of things that are related to investment or some sorts of investment. So it's very much a sector-specific story, I would say, rather than, say, a country-specific story.